Hello everybody and welcome to the Rainey Review for June 2024. This slide shows the growth of wealth for $1 invested in various asset classes for the 3 months ended 30 June 2024. After outsized returns in the March quarter, the June quarter delivered more modest returns, with half the asset classes delivering positive returns and half delivering negative returns. The somewhat surprising leader this quarter is emerging market shares in red, where $1 invested 3 months ago would have grown to $1.03. In second place is cash in green, which would have grown to just over $1.01. Middle of that half positive and half negative pack is a 50-50 mix of shares in property and cash and fixed interest, where $1 invested 3 months ago would have fallen to just under $1. Not a great start. This slide shows the growth of $1 invested in those same asset classes, this time over 12 months. The leader over 1 year is unhedged international shares in navy, where $1 invested a year ago would have grown to $1.21. In second place, just pipping Australian shares and Australian gold, is emerging market shares in red, where $1 invested a year ago would be just over $1.13. Australian shares were good for third, where $1 invested a year ago would also be $1.13. Middle of the pack is that 50-50 mix of shares in property and cash and fixed interest, which would have grown to $1.07. That's a bit more like it. 1 year is never long enough. I always say we need at least 3 years' data. This slide shows the growth of $1 invested in those same asset classes, this time over 3 years. The leader over 3 years is, again, unhedged international shares in navy, where $1 invested 3 years ago would have grown to $1.40. In second place is Australian shares in Australian gold, where $1 invested 3 years ago would have grown to $1.23. In third place is global infrastructure in orange, where $1 invested 3 years ago would have grown to $1.22. After that, the lines look a bit flat. Middle of the pack and meekly rising upward is that 50-50 mix of shares in property and cash and fixed interest, which would have grown to an underwhelming $1.04. As we discussed last quarter, while underwhelming, that is unusual. As the wise philosopher Kermit the Frog once sang, "It's not easy being green. It seems you blend in with so many other ordinary things." Today, I'm going to talk about green investing and why it may not always be easy being green. Like any good topic, before we address it, we need to define it. And this is where the problems, or to use Kermit's parlance, the lack of ease begins. There is no universally accepted definition of green investing or even being green. Green investing, environmental, social and governance investing, responsible investing, socially responsible investing, impact investing, the industry can't even agree on a single term, much less define what that term means. Luckily, there is a source that helps. PRI is a UN-supported group of institutional investors that has defined principles for responsible investment. PRI came up with this framework which splits investments into 2 buckets on an investment continuum, from only interested in financial outcomes to only interested in social outcomes. As financial stewards for other people's money, that helps define being green for Cambridge partners as ESG investment. So now we know that green investing is ESG investing, does that make things easier? Somewhat, but unfortunately even these terms lack universality. Well-respected investment body, the CFA Institute, and I acknowledge I would say that, being a CFA charter holder, defines ESG investment on the inclusive list above. This is as good a source as any. ESG considerations are predominantly, although not exclusively, used as negative filters. That is, if they do not satisfy any of the criteria above, they are excluded for consideration and investment. That's all very well and good, but what does that actually mean? Practically speaking, it means that some sectors are underweight or excluded from an ESG screened product, and others are overweight to compensate. Here's an example taken from Morgan Stanley Capital International, or MSCI, World Indices. Typically, ESG screen products have lower exposures to energy and utilities and higher exposures to information technology, financials and healthcare to compensate. The composition of the two indices is very, very close. However, the differences do have an impact on some important numbers. The ESG screen index has tracking error, that is, differences in the way that that index behaves relative to the broader index. Additionally, it has higher standard volatility or risk. That makes sense, as, by definition, excluding securities means that the ESG screen index is less diversified. Lower diversification means higher risk. ESG also tends to have higher exposure to large companies and growth companies as a consequence of that higher exposure to information technology. In addition, it also tends to have higher costs than the broader index. Because costs matter, we've looked into that. According to Y-Charts, ESG investors in the US paid 0.22% per annum more than non-ESG investors when getting exposure to US equities. Differences can be amplified when there are fewer options. That is usually the case here in New Zealand. As mentioned earlier, the compositional differences are actually quite small. They usually don't matter, except when they do. In 2022, they mattered. ESG investors underperformed the broader market in 2022 because of their underweight position in energy and utilities. Energy was the only materially positively returning sector in the 2022 calendar year. Being underweight energy and utilities and overweight information technology and communications meant that ESG screened investors underperformed non-ESG screened investors in 2022. But, as can be said about good comedy, the opposite can also be true. Here is the same sector data, albeit in a different format, for the 2023 calendar year. In 2023, the things that did well in 2022, energy and utilities, were the two worst performing sectors. As mentioned earlier, the compositional differences are actually quite small. Usually, they don't matter, except when they do. So, ESG screened investors outperformed the broader market in 2023 due to the same underweights to energy and utilities that led to underperformance in 2022. Swings and roundabouts, really. The moral of the story is that investing consistently with your values comes at a cost. The potential for short-term volatility and differences in return from the broader market. Over the long term, it is likely there is no material difference in expected return between ESG screened investment and non-ESG screened investment. Importantly, not materially different does not mean not different. But, to paraphrase these last two lines of "It's not easy being green," while being an ESG investor may result in some volatility, in the long run it will do fine, and investors should be what they want to be. Thank you for watching. I look forward to updating you later in the year with the next instalment of the Rainey Review.